Hello, and thank you for tuning in. Eric Jefferson with TrestleBridge Capital. Just wanted to share a couple of thoughts on Wednesday's announcement from U.S. Federal Reserve President Jerome Powell, who addressed the nation and confirmed the Fed would raise benchmark interest rates by 25 basis points. That's 0.25%, and look to do an additional 6 rate hikes throughout the course of this year to combat what has been now historic inflation or higher prices on everything from food and energy to shelter, et cetera. And this was a widely anticipated move, given that the Fed's ability to adjust rates is one of their primary levers that they use to accomplish their objective or their dual mandate of maintaining stable prices or long-term annual inflation of 2%, as well as fostering full unemployment or a strong labor market. Now, if you rewind 6 months ago, unemployment was above 5%, well in excess of pre-pandemic levels. You had inflation that was virtually non-existent, and as a result, the Fed kept interest rates near zero. That was part of their initial response following the pandemic in 2020. Now, fast forward 6 months, I have a very strong labor market, and inversely, inflation that is at all-time record highs. That is a function, obviously, of existing supply chain disruptions as a result of the pandemic. As well, you throw in a Russian invasion that has put significant upward pressure on energy costs, and now inflation is something impacting virtually every American. Now, given the negative impact of inflation on consumers, we certainly agree and support with the decision to raise rates. However, it's worth noting that higher rates are not without consequences. First, most lenders will benchmark their rates against the Federal Reserve, so likely expect borrowing costs for things like auto loans, credit cards, mortgages, student loans, all of that likely expected to march higher. Additionally, and probably the bigger concern is around our economy. And the concern there is if the Fed raises rates too aggressively, borrowing costs for companies become too expensive. They may no longer decide to fund that operation or make that additional hire. As a result, that could choke our economy, potentially sending us into a recession. Now, Chairman Powell made it very clear, both in his prepared remarks as well as in the Q&A afterwards, that the U.S. economy remains very strong. We are still growing above our long-term averages, although that rate of growth has slowed relative to where we were last year. 2021 was an exceptional year. A lot of that was a function of playing catch up from the COVID-induced pandemic the year prior. Furthermore, Powell offered a lot of comfort in that any future rate hikes would be data dependent, implying that they would take into close consideration a variety of economic indicators before taking any additional action. Now, based on his comments, the market is currently pricing in or forecasting a total of 7 rate hikes throughout the course of this year, although it's my opinion that that is potentially a little overdone. When we think about inflation, a lot of that is a result of supply chain disruptions. Again, not enough goods being produced relative to the excess demand. You also think about higher shipping and transportation costs that gets then passed along to the consumer. As well, if we, knock on wood, eventually get some positive resolution out of Ukraine, we'd all expect inflation to start to revert lower second half of this year. And as a result, anticipate that the Fed will likely wind up raising rates in the 4 or 5 times over the balance of this year. Now, given that base case, you've seen some changes to your portfolio. First, we've exited a series of positions that benefit based on the expectation of higher interest rates in the future, things like financials and banks. And we have replaced those with instruments or investments that actually appreciate during short and intermediate periods of extended inflation, things like commodity and commodity producers. And then lastly, we incrementally added more duration. Duration is a measure of interest rate sensitivity. Duration works against you when interest rates increase more than expected, works in your favor if rates remain range bound or decrease as we expect that they may. The trade-off is more duration typically translates to better yield or additional income. As always, love the opportunity to discuss any of that in more detail. If we don't chat, have a great rest of the week and weekend. Take care.